The most dangerous collapses of the financial system always happen when no one is paying attention. December 26th, Boxing Day, the lowest liquidity period of the entire year for the global financial markets. There was no major economic data. There was no Federal Reserve meeting. There was no new geopolitical crisis. There was no piece of news big enough to explain any kind of market move. And yet, in that very moment of silence, the price of silver broke above 75.60 US dollars per ounce. It did not jump and then fall back down. It was not pulled back. There was no selling pressure strong enough to stop it. This was not a spike. This was a breach. For more than 40 years, the price of silver had been kept in check by a familiar mechanism: paper contracts, trading algorithms, and artificial liquidity. Every time the price approached a sensitive zone, enough sellers would appear to cool off any upward momentum. That mechanism worked smoothly through many cycles, from the 1980s to after the 2008 financial crisis, from quantitative easing to monetary tightening. But on that Boxing Day, the familiar mechanism stopped responding. Sell orders did not appear on time. Algorithms did not push the price back down. Liquidity did not magically show up. The price rose not because buyers were unusually aggressive, but because sellers had simply run out. Financial history shows that every price control system collapses in the same way, not loudly, with no warning, not during panic, but in the moments that seem the most harmless. London nickel in 2022, gold in the late 1970s. Those episodes did not begin with bad news. They began when a familiar reaction failed to occur. When the price crossed a level it was never supposed to cross. When no one stepped in to fix the system. That is no longer normal market volatility. That is a signal that a control structure has lost its ability to defend itself. And the greatest paradox is this: what is frightening is not that silver went up, it is that for the first time in decades, no one was capable of holding it where it used to be. To understand what just happened with silver, we need to move past the familiar question the market always asks incorrectly: where is the price going? The correct question is, what system is operating behind that price? In finance, price is rarely the result of natural supply and demand. Most of the time, price is the product of a control mechanism. In silver, that mechanism has existed for more than 40 decades. It is not secret, it is not illegal. It is simply an operating structure built on a volume of paper trading that is vastly larger than the amount of metal that actually exists in the physical world. Within this structure, silver is traded primarily as contracts, not physical silver, not something that is mined, transported, and stored, but promises on paper, bought and sold at millisecond speed. As long as there are enough sellers willing to appear every time the price rises, order is maintained. The problem is this: every price control system has a stress limit. History shows that when a mechanism is stretched for too long, it does not collapse in a dramatic way, it does not explode, it does not give warnings. It simply stops responding. This pattern has appeared many times across different markets, and it always follows the same sequence. The first stage is the dominance of the paper market. This is when prices are smoothed out, volatility is compressed, every rally is sold down. The market looks stable, even boring. Most participants believe this is normal. In reality, this is the pressure accumulation phase. The second stage is seller exhaustion. This is where many people misunderstand what is happening. Price does not rise because someone suddenly becomes optimistic. Price rises because the participants who used to sell in order to maintain order are no longer willing to sell. They have sold too much, for too long, at prices that no longer make sense relative to the risk they are carrying. By the third stage, the system is forced to consume itself. The entities that once kept prices low now become forced buyers, not because they want to, but because they must defend existing positions, signed contracts, and hedging structures built in the past. The price controllers become the fuel for the rally. And finally comes the most dangerous stage, the break between the paper market and the physical market. At this point, prices on screens still exist, but they no longer reflect real access to the underlying asset. Gaps appear, premiums rise, delivery times stretch out, trust in the central pricing mechanism begins to crack. This is important to emphasize. This is not a speculative cycle. This is a structural cycle. It does not depend on crowd psychology. It depends on the operating capacity of the system itself. Nickel in 2022 is a textbook example. When prices surged too quickly, it was not small retail investors who caused the chaos. It was large short positions that pushed the market out of control, forcing the exchange to step in with administrative intervention. Gold in the late 1970s followed similar logic, when the monetary system lost its ability to function as a stable value anchor. For many years, silver was considered an easy-to-control market, high liquidity, massive contract volume. But those very characteristics made it fragile once the underlying conditions changed. Boxing Day did not create the problem, it exposed a problem that already existed. When the market entered its thinnest liquidity window, every safety cushion disappeared, and only then did it become clear that the mechanism that once kept prices stable no longer had the strength to perform its familiar role. This pattern does not tell us how far prices will go. It does not offer targets. It does not promise outcomes. It does only one thing. It shows where the system stands within its own life cycle. And when a system shifts from control to passive reaction, the most important thing is no longer predicting the future. It is recognizing that the old order has ended, even if the surface of the market still looks calm. For decades, the silver market was not controlled by humans, it was controlled by machines. The trading algorithms of bullion banks were designed for one very specific task: flatten volatility. When prices rose too quickly, the system automatically increased selling volume. When liquidity was thin, the system spread orders over time to avoid attracting attention. Everything ran smoothly, repetitively, and almost invisibly. That is why most silver rallies in the past ended the same way. Price approached a sensitive level. Selling pressure appeared. The rally was broken. Order was restored. But this time, the familiar response did not happen. Boxing Day is the most brutal stress test for any automated trading system. Liquidity is thin, volume is low, error margins are high. Under those conditions, algorithms have very few options. Either sell aggressively and accept severe slippage, or do not sell at all. And the market discovered an uncomfortable truth: sell orders were no longer appearing at the scale required. This is the moment a melt-up begins, a concept that is often misunderstood. A melt-up is not a speculative frenzy. It is a state where prices rise steadily simply because there is no longer enough supply willing to sell at previous levels. Buyers do not need to rush, they only need to exist. When sellers disappear, price does not need a story, it only needs time. The next effect showed up almost immediately in the derivatives market. Options contracts are built on the assumption that price will remain within a familiar range. When price moves beyond that range, options writers are forced to buy the underlying asset to hedge, not because they believe in the trend, but because they have no alternative. That is a gamma squeeze, a purely mechanical reaction. The higher price goes, the more buying is required, and each forced purchase makes the situation more unstable. At the same time, another risk quietly formed: gap risk. During holiday periods, markets do not trade continuously. Short positions get trapped overnight, over weekends, through gaps where no adjustments are possible. When the market reopens, price does not return to where it was, it jumps, and each gap destroys another layer of protection. What stands out is this: there was no panic, no stampede, no flood of retail money rushing in. The system operated in a cold, almost emotionless way. But that silence was the most dangerous signal of all. In past crises, systems collapsed because too many people reacted at the same time. This time, the system wobbled because there were no longer enough participants reacting in the old way. Algorithms do not panic, they simply do what they're programmed to do, and when market conditions move beyond their original assumptions, algorithms do not fail emotionally, they simply become useless. History has recorded this moment before. The London Metal Exchange in 2022, when nickels surged, not because of a sudden spike in industrial demand, but because short positions could not exit in a deteriorating liquidity environment. The result was not price adjustment, but trading suspension. The difference this time is simple. There is no pause button for the global silver market. When algorithms lose their ability to lead, the market shifts into instinct mode, and in that state, only one thing matters: who is forced to buy and who is no longer able to sell. This is the first domino to fall, not loudly, not with headlines, but once algorithms can no longer keep the rhythm, the rest of the system is simply waiting its turn. In most market narratives, technical analysis is often dismissed as a tool for short-term speculation, price lines, patterns, entry points. But at the system level, technicals are not a forecasting tool, they're capital triggers. As silver moved towards $75, most of the market saw a round number, a psychological resistance level. But for long-term institutions, it meant something entirely different. It marked the boundary between two states, an asset under control and an asset beginning to escape control. The cup and handle structure that formed over decades was not the product of belief or expectation. It was the result of compressed time. Every time price was pushed down, every cycle that was cooled off, every injection of paper liquidity used to maintain order left a trace. When those traces stack on top of each other for long enough, they form a structure that does not need explanation. It only needs to be broken. The moment price moved through that zone, a completely different kind of capital began to move. Not hedge funds, not traders, but pension funds, capital preservation funds, and portfolios bound by allocation rules. For them, this was not a tactical decision, it was a system response. Their asset allocation models do not ask why, they only ask, has the condition been met? And once a long-term technical threshold is broken, that condition is officially triggered. This is where the liquidity trap begins to form. The silver market is not deep enough to absorb long-term capital flows over a short period. It never was. For many years, surface liquidity was sufficient because trading took place primarily between paper contracts. But once non-speculative capital enters, every old assumption becomes obsolete. Price does not rise because demand suddenly explodes. It rises because the market no longer has enough elasticity to absorb new demand. Each long-term buy order drains another portion of already thin liquidity, and when liquidity disappears, volatility is no longer a choice. It becomes an unavoidable outcome. The most dangerous aspect of this phase is the sense of false stability. There is no new breaking news, no dramatic headlines. Prices rise steadily, in an orderly fashion. That convinces many people the market is still under control. But at the structural level, this is when the system is at its most fragile. History has shown this before. Before gold entered its major repricing phase in the late 1970s, most of the advance happened quietly. No fear of missing out, no crowds, only long-term capital rebalancing before the media even realized the story had changed. The difference this time is that silver is not just a financial asset, it is an industrial input, it is a strategic metal, and when long-term capital meets a market that has lost algorithmic control and lacks physical liquidity, the trap is triggered from both directions. Those on the outside feel no pressure, those inside the system begin to feel the walls closing in. And that is the nature of a liquidity trap, not when everyone wants to get in, but when there is no longer enough room to get out. When technicals shift from signals into mechanisms, the market no longer moves on narrative, it moves on structure. And once that structure changes state, price itself is no longer the central issue. What matters is recognizing this. A market does not become dangerous when it turns volatile. It becomes dangerous when it looks too orderly, while the foundation underneath has already changed.
For most of the 20th century, commodity pricing power did not reside where commodities were used. It resided where they were financialized. New York, London, centers where contracts were written, not where metals were consumed. Silver was no exception. For decades, comex played the role of the global price reference, not because the United States consumed the most silver, but because the American financial system was deep enough to turn silver into a paper product that could be traded without limit. Prices were determined by contract liquidity, not by physical flow. But pricing power only exists as long as the participants who accept that price still trust the mechanism behind it. When silver broke through sensitive levels in a thin liquidity environment, another phenomenon became impossible to ignore: a persistent price divergence between East and West. The Shanghai exchange did not react the way comex did. Prices were not forced down in the same manner. Physical flows did not reverse according to algorithms. Arbitrage appeared, but not the kind of financial arbitrage where price gaps are quickly erased. This time, the gap lasted long enough to become a signal that physical silver was being valued more highly where it was actually used, rather than where it was traded on paper. When that happens, power begins to shift. Silver starts leaving Western vaults, not because of panic, but because of supply chain logic. Metal flows toward production centers, where demand is not optional. Solar energy, electrification, defense industries. These are not sectors that can wait for prices to correct. Once silver leaves a vault, it does not return quickly. Unlike money, unlike bonds, physical metal has inertia, and that inertia gradually weakens the role of traditional pricing centers. At a higher level, this shift does not occur in isolation. It moves alongside a broader change in the global monetary order. Countries outside the United States dollar system do not view silver as a speculative asset. They see it as a strategic tool, an industrial input, a store of value that does not depend on Western payment networks. In that context, silver is no longer just a commodity. It becomes part of a power realignment. No official announcements required, no press releases needed, only a change in the direction of physical flow. History shows that pricing power always follows physical flow, but with a delay. Oil, gold, natural gas. When centers of consumption and storage change, pricing centers are eventually forced to follow. What is dangerous for the old systems is not the immediate loss of control. It is the gradual loss of centrality without realizing it. Prices are still quoted, contracts are still traded, but the reference role begins to be questioned. And when a market loses its reference role, every control mechanism built on top of it becomes fragile. This is the second domino. It does not create instant volatility, but it changes the direction of the entire structure, from west to east, from paper to physical, from financialization to real use. And once pricing power begins to shift, the question is no longer how high the price is. It becomes, who still has the authority to decide what that price actually means? Every modern commodity market is built on a core assumption that the price on the screen is a valid representation of access to the real-world asset. Not everyone needs delivery. There is not always enough supply. But as long as the system can maintain confidence that conversion is possible, order is preserved. With silver, that assumption has been quietly eroding for years. On Western exchanges, silver exists in two very different legal states: registered inventory, metal that is specifically designated and ready to be delivered against contracts, and eligible inventory, metal that sits in vaults but is not committed to delivery obligations. On reports, both are counted as inventory. In reality, only a small portion can actually leave the vault when called upon. Under normal conditions, this distinction does not cause problems. Most contracts are settled in cash. Very few participants request physical delivery. The system operates on probability, and for many years, that probability favored the paper market. But when the control structure begins to destabilize, probability is no longer a strong enough foundation. When price breaks through long-term thresholds, the market begins to attract a completely different class of participants. Not traders, not short-term speculators, but end users. Companies that need silver to keep production running. Solar energy, electric vehicles, defense industries. This is not optional demand. This is mandatory demand. This demand does not respond to technical signals. It doesn't care about the market narrative. When production lines need silver, they must buy it, regardless of the quoted price. And they do not buy contracts, they buy metal. This is where the fracture becomes visible. The price on the screen may still be quoted around a number that looks reasonable, but the price required to actually access physical silver begins to separate. Premiums rise, delivery times extend, distributors stop offering firm quotes, not because of speculation, but because physical supply is no longer flexible. What matters here is that this is not an absolute shortage. Silver is still being mined, it still exists within the system. The problem is that it is no longer located where the paper market needs it, and it is no longer in a state where it can return to its old role of stabilizing price. When silver leaves the vault and enters the production chain, it is no longer mobilizable inventory, it becomes industrial input. And once it becomes input, it disappears from the price control mechanism. History has seen this before. When gold was price controlled in the 1970s, parallel markets emerged. The official price still existed, but the real price was something else. Not because of fraud, but because the system no longer had enough supply to defend its own pricing narrative. The most dangerous aspect of this phase is not price volatility. It is the weakening of trust in the conversion mechanism itself. Once a large enough share of participants begins to doubt that paper contracts still represent access to real assets, the entire pricing structure is called into question. There does not need to be a panic. There does not need to be a catastrophic event. There only needs to be a change in behavior from those who must buy physical metal. This is the third domino, and it is also the hardest to reverse, because once the link between paper and physical is broken, no amount of synthetic liquidity is enough to restore it. At this stage, the market is no longer debating direction. It is facing a far more fundamental question. Does the thing being traded millions of times on screens still actually exist where it is being promised?
When a market enters a structural repricing, the question is no longer who is right or who is wrong. The real question becomes who is the most exposed. Silver prices have moved far above average mining costs, which for many years hovered around the low to mid $20 range. On the surface, this creates a very clear picture of opportunity for mining companies. Profit margins expand, cash flow improves. Mining stocks often react faster than physical metal because of leverage, but history shows that leverage always comes with fragility. In past commodity cycles, mining equities tended to perform best in the middle phase of repricing, yet they were also the group that suffered the most once market structures became unstable, not because operations deteriorated, but because they were trapped between two worlds. Output prices swinging violently, while input costs, regulation, taxation, and geopolitical risks failed to adjust in time. At the system level, the greatest risk does not come from the uptrend itself, it comes from deliberate disruption. When a market slips out of control, attempts to regain control often appear as sudden shocks, flash crashes, short, violent sell-offs, moves that do not reflect supply and demand, but psychological pressure. The goal is not to change the structure, it is to shake out those without patience. These drops are not signals of an ending. They usually appear during the phase where the old structure is weakened, but the new structure has not yet been fully accepted. This is the gray zone, where volatility is high, but information is scarce. And that lack of information is what creates the greatest risk. Another factor that is often overlooked is asset security. When a nominal value of an asset rises quickly, risk does not stay confined to markets. It spills into real life. Storage, security, access. In past cycles, many people misjudged risk because they measured it on charts. The real risk emerged off the charts. That is why in communities that understand cycles, an old principle is often repeated. Gray man, do not stand out, do not draw attention, do not behave as if the system around you is still as stable as it used to be. When prices move faster than social awareness, that imbalance alone becomes a risk. It's important to recognize this. Not all risks are financial. Some are behavioral, some are social, and some only appear when an asset transitions from numbers on a screen into an object in the physical world. Most market participants are accustomed to measuring risk through price volatility. But in this phase, the larger risk lies in how the system reacts when it is challenged. Rules once considered untouchable can be adjusted. Mechanisms once trusted can be suspended, not because they are wrong, but because they no longer serve the goal of stability. This section does not point to a course of action. It clarifies one thing only. When a market enters structural repricing, rewards and risks no longer distribute themselves in familiar ways. And in that environment, understanding what kind of risk you are facing matters far more than believing you are on the right side of the trend.
In every major financial cycle, there is one phase that is uniquely dangerous. Not when markets panic, not when headlines are filled with fear, but when the structure has already changed while collective awareness has not. That is exactly where we are now. Price has left the old control zone. Algorithms have lost their grip. Physical flows have changed direction. Yet the mainstream media remains silent. There is no dominant narrative, no unified explanation. That silence creates a familiar illusion that everything is still under control. History shows that this is when systems are at their most fragile. Those who understand structure have already adjusted their behavior, while most of the market continues reacting according to old habits. There are fewer active sellers, but there is still no wave of emotional buyers. From a distance, the market looks normal. On the inside, it has already entered a different state. This phase does not carry the tone of fear of missing out. It carries the tone of disorientation. Those who look at price see that it is high. Those who look at history see that it has never been here before. Those who look at the system begin to notice that familiar reactions are no longer showing up. The danger is not that price may correct. Corrections are a natural part of any market. The danger is that many people are still measuring risk using models that no longer apply to the system's new state. In past cycles, when an asset moved from a controlled phase into repricing, markets often produced movements that felt illogical, not driven by news, not driven by macro data, but driven by structural pressure. These movements confuse both sides. Bears do not understand why price does not collapse. Bulls do not understand why price does not explode immediately. That ambiguity erodes perception. Without confirmation from the media, many assume what is happening is just noise. Without crowd participation, many assume the risk has passed. But history shows that the quiet phase always comes before collective awareness takes shape. Once the media begins telling the story, most of the structural shift is already complete. Those who needed to act have acted. The most important flows have already moved in silence. What matters is that markets do not need consensus to change state. They only need resistance to disappear at key points. And when that resistance vanishes, the phase shift happens without announcement. The most dangerous phase is not when everyone is euphoric. It is when people are still debating whether anything meaningful is happening at all. At that point, trying to predict the next price move becomes far less important. What matters is recognizing that the system being observed is no longer operating under its old logic. And when old logic no longer applies, old reflexes become a form of risk. This is not the climax of price. This is the climax of perception. Because in every major cycle, what comes after this phase is not a return to the old order, but the acceptance of a new one. Late, reluctantly, but irreversibly. At this stage, continuing to ask where the price will go is no longer the most important question. Financial history shows that when a price control system begins to crack, the number on the screen is merely a delayed outcome of changes that began long before anyone noticed. $80 or even a move into triple digits is not the target to focus on. These are only psychological thresholds, the points where mainstream media finally starts paying attention, not because the structure has just changed, but because the structure can no longer be ignored. By the time headlines appear, the hardest part of the process is usually already behind us. This has happened before, with gold, with oil, with many assets that were controlled for long periods of time. The media does not detect structural change. It reflects it only when the evidence becomes too obvious to dismiss. And by then, the story is told as if it has just begun. In reality, the most important signals always appear much earlier, in inventory data, in delivery behavior, in the unusual silence of tools that once maintained order, in the fact that familiar system reactions no longer function the way they used to. This piece is not meant to conclude where silver will go next. It points to something simpler, but far harder to accept. We are witnessing the end of a control mechanism that has existed for more than 40 decades, not through a single dramatic event, but through the accumulated fatigue of the system itself. When a structure loses control, it does not collapse immediately. It continues to exist in a suspended state. Prices are still quoted, contracts are still traded, but confidence in centralized coordination gradually erodes. And once that confidence disappears, no policy, no algorithm, no short-term intervention can fully restore the old order. The final message here is not a call to action. It is a reminder of how to observe markets. Do not view silver as a get-rich-quick story. Do not view numbers as promises. Watch the reactions of the system, what still works and what has stopped working. Because in every major cycle, the advantage does not belong to those who guess the exact top or bottom. It belongs to those who recognize when the larger picture has changed, even while the surface still looks familiar. And the greatest paradox is this: by the time most people begin paying attention to the price of silver, the real story is no longer about price at all.